Welcome to the Explainer. Today, we're going to look at a financial system that operates on a completely different philosophy and see how it's being used to build some of the world's absolute biggest projects. So let's start with a really big question. How do massive, multi-billion-dollar infrastructure projects, the kind that connect continents or completely redefine a city's skyline, how do they actually get paid for? I mean, these things are so huge, so expensive, and so risky that no single company could ever just write a check for them.
Well, the answer lies in a really specialized technique known as project finance. It's a method that's been around for centuries, believe it or not, from funding old-school trade expeditions to building today's modern marvels. It's designed specifically for these giant, long-term, and kind of scary ventures.
Okay, so let's get into how this works. At the very heart of project finance is something called a special purpose vehicle, or an SPV. The easiest way to think about it is like a brand new company that's created for just one job. Its entire purpose is to be a financial firewall, a protective bubble that separates the gigantic risks of the project from the companies that started it. So here's the basic playbook. The sponsors, the big companies behind the idea, they create this SPV. That new company becomes the legal and financial container for the whole project. It signs all the contracts, the supply agreements, everything. But here's the really crucial part. Lenders give what are called non-recourse loans directly to that SPV. What that means is, if the project totally fails, the lenders can only go after the project's assets, the tunnel or the power plant itself. They can't touch the sponsor's other businesses. The debt gets repaid only from the money the project itself makes down the road. Now, this is where things get really interesting. We've just talked about loans and debt, but what if we challenge that most basic assumption of modern banking? What if lending money to earn interest was just forbidden? How on earth would you finance anything? And that question brings us to a completely different moral and economic framework, Islamic finance. It's a system that actually has an answer to that very question, and believe me, it's becoming a major force in global markets. So this system is based on Islamic law, or Sharia, and it operates on principles that are just fundamentally different from conventional banking. The absolute cornerstone is the prohibition of riba, which is interest. Instead of interest, the system is built on partnership and fairness. Financiers have to share in the actual risk of the business. They can't just lend money, sit back, and collect payments. They have to have some skin in the game. The system also forbids things like excessive uncertainty in contracts, known as gharar, and pure speculation, or maisir. And this chart illustrates that difference perfectly. In conventional finance, money is basically treated like a commodity. You can rent it out for a price, and that price is interest. But in Islamic finance, money has no value on its own. It's just a way to exchange things. The real value comes from actual, tangible assets and productive businesses. So the risk, and this is key, isn't just dumped on the borrower. It has to be shared. So, you're probably wondering, how does this actually work without loans? Well, Islamic finance uses specific contracts that are based on trade and ownership. So, instead of a construction loan, you might use an Astana contract. That's where the financier agrees to fund the construction of an asset, which they later sell or lease. For big equipment, a bank might just buy it and then lease it to the project using an Ijara agreement. And if you want to raise money from lots of investors at once, there's something called a sukuk. Okay, that's the theory. But does this stuff work in the real world, like on a massive scale? To see, let's look at a landmark case that really proved this system could play on the global stage. $20 billion. That was the price tag for the Sidera project, a gigantic petrochemical complex in Saudi Arabia. It was this huge joint venture between two industrial giants, Saudi Aramco and Dow Chemical. A $20 billion bet on the future of chemical manufacturing. Now, to fund something this big, the sponsors didn't just pick one system. They created this really sophisticated hybrid model. As you can see here, they pulled in money from all over the place: government export agencies, public funds, and of course, conventional bank loans. But a huge, absolutely critical piece of that funding puzzle was Islamic finance. The star of the show here was a large issuance of sukuk. Now, a sukuk might look a little like a bond, but it is fundamentally different. It is not a loan. It's a certificate of ownership. When you buy a sukuk, you are buying a direct, fractional share in the project's physical assets. Your return doesn't come from interest payments. It comes from the actual profits those assets generate. And this wasn't some small, niche investment either. the Sadara Sukuk raised $2 billion. It was a massive success that proved this alternative faith-based model could stand shoulder to shoulder with the biggest players in global finance to fund a truly world-class industrial project.
So what's the big takeaway from all of this? Well, it's about more than just one project or one type of financial system. It's really about the future of how we build our world.
The thing is, the world has a massive infrastructure gap. We need to invest trillions of dollars in new energy, transport, and water systems. And this quote gets to the heart of the problem. The financial sector is vital, but traditional sources of money, like banks, just aren't always enough. This is driving a global hunt for new, stable, and long-term sources of capital.
So here's the bottom line. Project finance is an incredibly flexible tool. Islamic finance offers a robust, asset-backed alternative that's appealing not just for religious reasons, but also for its focus on ethical principles and sharing risk. And, as the Sandara project shows, these two systems can be integrated. You can create these powerful hybrid models that can fund huge projects and tap into these vast new pools of capital from investors who want to align their money with their values.
And that leaves us with a final, pretty big thought. If the global financial system can adapt to include one powerful ethical framework, what other values, things like sustainability or social impact, might start to shape how we choose to invest in and build our shared future?